Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter information. It's mainly about commodities and the stock market and interest rates in this one particular, and real estate. So I'm going to go over all of it. And I'm just going to kind of note some observations that I have when looking at all these, charts and data and stuff. Some things that I kind of mentally noted when I was looking at it, and some things that are a little bit different than other cycles. And the question then is, why is it different? Why is this time a little bit more nuanced or different than other times? So we'll dive in here. I'll give you my financial opinions. Again, if you want to follow me, it's at finding_finance. And if you guys need any help with anything, definitely check out my website, finding-value.com. So we've got the Bank of Japan has announced an emergency bond buying operation. They've been doing that for the past, some months, or the past year, I should say. What is going on with the bond market in Japan? Could it come to America? And I'm looking at there's a disconnect in the market right now, guys, and I'm going to talk about it real quick. The disconnect is we've got home prices going down. At the same time, we've got inventories that are very low, and we've got interest rates continuing to go up. A very weird mix. Generally speaking, looking backwards, the housing market would pace interest rates. And what that means is you'd get this oversupply, then prices would peak, and they'd come back down. And then the interest rates would follow that entire cycle. What is going on here? And I'll show you the data as we come up. It's like, how's the market having home prices drop and interest rates continue to go higher? What that means is that the housing market isn't the pacing factor. Something else is. What is that something else? And let's just keep looking at data here. So it says the drop in existing home sales is unbelievable. And this is sales. So we're coming on down, and we've dropped. And I've got another kind of thread that we can look at that goes into more of the real estate market a little bit more. This says, after plunging by 84% from the peak, rate to ship 40-foot container from Shanghai to Los Angeles looks to have stabilized for now. So these are container freight rate. And you can see we've come all the way back down. It is stabilizing. And we've got a lot of support underneath us all through this area here. So what drove this big move? And is this move here a lead-in pattern to something that's bigger that is coming? I don't know. We'll have to see if a bigger wave comes behind it, which I think is possible, because I think a lot, and I don't know about container freight rate. I'm saying a lot of the charts that I'm looking at, I think will have other waves in it, but I don't know if container freight will or not. And I think that's going to deal with commodities and the lack thereof commodities in the future. Looking at this is the one-year Treasury yield is firmly above 5% for the first time in years. Markets are panicking about short-term interest rates. And what that means is people are selling bonds. The whole curve went up today massively. They're selling bonds, and the question is, are they selling it because they're afraid of bonds and maybe the potential that they're going to get paid back in inflate or deflated dollars that are worth a lot less? What is going on? Why are interest rates rocketing higher? The 10-year, the 1-year, the 30-year. The housing market is not pacing that. There's no way. Something else is pacing it, and something else is creating this fear in the market. And maybe it's countries dumping bonds like heck. We've got 90% of all millionaires invest in real estate of some sort, and for good reason. Real estate is the only asset class that gives you all four of these benefits: appreciation, cash flow, tax advantages, and leverage. And I do think that is an accurate reading of real estate. We've got the US 10-year yield. So I was talking about the 10-year yield. It's breaking out of a bull flag. And the measured move is to a little over 5%. It would be the highest since 2007. There's the measured move all the way up to about 5%. And this is your halfway flag pattern. So they took this and projected it up from the bottom up. So we've got higher projections for interest rates. That means people are selling bonds en masse, and the yields are working their way higher. This is U.S. air travel, TSA total traveler throughput in million passengers a day. So more passengers are flying over time, and we're beating 2019. We've got Suncor. Suncor is a oil, kind of an oil sands company for better measure. It's a big company. Price objective is $60. You can kind of see this consolidation we're in. We could get a move higher with the price objective. Now, we could pull back. We very well could. A lot of the small companies are even far more leveraged than this thing. And we're in a big consolidation period. Some of them are breaking to the downside in natural gas. They may take some time to consolidate. And natural gas may take some time to consolidate after this big move to the downside. We've got copper. Have a look at the volume. So copper is heading higher on very good volume here. Increasing volume as this thing is ready to explode higher for copper prices. So copper is looking really good. The demand supply is very strong in commodities across the board outside of natural gas with the warm weather in Europe and warm weather in America too, I should say. And across the board for a lot of other things like oil, jet fuel, gasoline, et cetera, around the world, it does look pretty robust. So this is the one I wanted to get into, this thread here. It says, what a housing reset looks like. It took the biggest collapse in sales in 1 year to get days on the market over 30 days. And this is your collapse in existing home sales to get it over 30 days. You come down and says, I know the total inventory is under 1 million and the monthly supply is below 3 months. However, the days on the market are above 30, which is back to a typical marketplace. But we've got really low inventory levels, and your mean is way up here. It's insane to see how fast this housing market has shifted, and we still have very low inventories. Now, I don't think in the history of the housing market have we seen prices drop like they have and inventories stay this low, which means interest rates are being pushed higher by a different factor than what we had in history. Something is different. Because in order to have house prices go down and the inventory levels be at that level, we have not seen that in history before. They've always had inventory levels go up with prices going back down, which was the pacing factor of interest rates. Now, something else is pacing it. I don't know what that is. I wish I knew. It says, for some historical context, back in the late 1970s, we went from 4 million sales to 2 million. The housing bubble peaked in 2005. It took more time, of course, to get monthly sales back to 2007, where we are today. He says, this is why I say if you're a 1970s inflation person, you're betting big on housing inflation taking off like then. And we had these gigantic waves that came in the 1970s, and I do think it was partially driven by demographics and also partially driven by oversupply phases that kicked in these 3 cycles. They flooded the markets with homes, but we also had a very large demographic. We've come up, this is rent inflation. We've come up quite a bit in rent inflation. And these are the 3 cycles in the 70s for rent inflation. It says, what I've learned over the past 2 years is that most of you didn't know what housing inflation looked like in the 1970s or what housing demand looked like then. If you're in the 1970s, this data line needs to explode higher at least 2 more times after the growth rate cools. And this is National Single Family Rent Index year over year on a percent change by price tier. And he's saying that this is going to explode higher again in more waves behind it. And it says, but that wasn't demand collapsing as much as behavior stopped living normal. Housing demand shot right back up. We don't have that backdrop here. This is real demand destruction here. So it says, to be fair, shutting down our entire economy for a cold was unprecedented. The fallout was unprecedented. So coming down, we've got natural gas. Natural gas continues to get obliterated and is now trading at prices not seen since September 2020. I do think that there's even a possibility we could come all the way to the bottom down here. So I do think there could be further downside. A lot of the times I see this pattern play out. It goes all the way back to where it started, and then we track back up again. Be patient on natural gas. Inventories are pretty full over in Europe. They have not been drawn down, and that will impact liquefied natural gas demand from Europe. Definitely. But we do have China reopening, and their liquefied natural gas demand is going to go up. We've got India's silver imports hit a record high in 2022 at just under 10,000 tons. This was roughly 1/3 of all silver mined on the planet last year. Buyers in India are scooping up all of the undervalued silver available. Look at that. That is crazy, the silver imports in 2022. Highest it's ever been. It says, big buying by insiders for Thesis Energy. It says, on February 17th, 4 insiders spent a total of $2.4 million on shares. 97,000 shares were bought at an average price of $24.69. In January, Thesis bought back 1,038,000 shares at an average price of $25.67. There are a lot of insiders starting to pick up shares in these oil companies, and some of them natural gas companies. So it is interesting to see insiders buying. We're seeing some insiders buy also on some of our energy service companies. So the buying is there. They know what's up, and I tend to agree with them. But it's going to be a rough ride. I'll just say that, especially for natural gas here in the short term. Mega cap tech still in a bubble. Valuations for the top 10 mega cap tech stocks are still higher than they were for their comps at the peak of the tech bubble. Enterprise value to GDP is the relevant measure here because once the underlying fundamentals for a group of companies have grown so large relative to the economy as it has for these firms, then collectively these companies can no longer grow at any faster than the economy at large. They essentially are the economy. And when the fundamentals for these businesses start to turn negative, yet the enterprises are still valued as if they will grow many times faster than GDP, then it is a mania whose unwinding can lead to the entire economy into a recession. Median free cash flow per share growth for today's former leaders has in fact already turned negative on a year-over-year basis, just like it did for their comps back in 2000, 2001. Revenue and earnings per share at the medium have already turned negative in real terms today compared to inflation at 6.4%. They've been lining up to buy what is likely a mere bear market rally in these stocks at a whopping 30 times earnings, when median year-over-year earnings per share growth is just 2.8% and poised to further deteriorate. This is another bubble for 2021 top 10 mega cap tech stocks. It's probably going to get another rally up, and then we're going to head lower. That is the bull trap. The bull trap in a bear market. I do like that tweet, though. We've got the average 30-year fixed rate U.S. mortgage climbs to 6.87%. That's the highest reading in 2023. I think this is the driver of what's killing the housing market, but that also is probably the Federal Reserve dumping maybe their mortgage-backed securities and stuff. And also the interest rates rocketing higher on bonds. It's all tied together. The problem with natural gas production this year is that even if gas-centric producers slow down production, U.S. shale oil will keep increasing as its production mix gets gassier. So as these shale oil, as they pump these wells and they get older, they become more and more concentrated with natural gas. So that is something to think about. Natural gas will also be substituting for coal at some point because natural gas is so cheap, it's going to yank coal prices back down too, I think. For Morgan Stanley Research, is the cycle turning? So what we've got here is expansion, downturn, repair, and recovery. And could we fall lower here? That is a possibility. Is the cycle turning? And this is Morgan Stanley Research, Haver Analytics. And the expansion phases are typically above the average line, moving higher. Coming back down, downturn, going below that median average is a repair, then a recovery, and then we move on and on and on as this thing goes over and over and over. So is this a downturn, and will commodities go down in this downturn? That is the question. So I also posted this for Ronnie, and we'll go over it here. It says, CapEx across commodities continued to fall in real terms, despite higher prices. Oil and gas and metals and mining, real CapEx in 2002 dollars. We peaked out in 2014, and we've really declined here at very low levels for CapEx. Now, if I zoom down here, I'm going to just go to this one here. It says, oops, I'll open it this way. I can just read it from the side. Expecting a pivot, then commodities should be on your shopping list. This is the 1980 bear market. So this is in both prior super cycles, commodities rally as the Fed cuts. So as the Fed cuts their interest rates, commodities, which is this lighter blue line, went higher during that time frame. It also went higher in the 2007 to 2008 rally there. It went on up, even though the Fed funds rate went down. So commodities went up when the Fed funds rate went down. And that's kind of the last hurrah before crashing on out. So will this happen again? I would tend to think so, because as the Fed funds rate goes down, those commodity prices give one last hurrah. So I think, a high possibility of that happening again. But that'll be the time we need to exit our positions, at least exit my positions, is when that happens. We've also got, there's no better teacher than history in determining the future. There are answers worth billions of dollars in a $30 history book. I think that was pretty sweet. Here's another one. It says, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Totally agree with that. I think there was one or two, videos ago, I said something on the lines of that, but I totally agree with that. Here's existing home sales crashed by 37% year over year. But this is Lawrence Yun, the NAR's chief economist, says home sales are bottoming out. That could be the case, guys. Says, really, does anyone see this as a bottom of real estate at this point? Actually, at some point, it's got a bottom, guys. It's had a pretty big pullback, and I think it depends on why interest rates are going up. If interest rates were to go back down, I do think that home sales and home prices would recover. I think that the demographics are there and they can buy it. Right now, it's just unaffordium. I'll call it unaffordium at this time. And this is, I went over that yesterday about natural gas. So that's where I'm gonna stop it there, guys. That's what I've got for today. Hopefully, we talked a lot about real estate and some other things, associated with commodities and the commodity super cycle and stuff like that. But if you guys like the content, give me a thumbs up. If you guys need any help with anything, definitely check out the finding-value.com. We do have a 5 p.m. Mountain Standard Time Platinum question and answer session on Sunday, 5 p.m. Mountain Standard Time. We'll see you there if you're a part of the website. If not, we'll catch you tomorrow. This is Finding Value.